I'm Craig Dunbar. I'm professor of finance at the Ivey Business School. And I'm pleased to host today's Arkadi Kuhlmann Lecture Series in honor of a celebrated Ivey alum, Arkadi Kuhlmann. Arkadi was first introduced to the world of direct banking with a simplified customer focus when he founded ING Direct Canada in 1996 and ING Direct US in 2000. Prior to this, he served as president of North American Trust and CEO of Deek International Inc., New York, as well as an executive of Royal Bank of Canada in Toronto, Canada. Today, Arkadi is founder and general partner at Deek Companies, LLC, and currently serves as chairman, Dumont Aviation Corp. Inc., and has board positions with Finexact, InvestX, and Savannah Inc. He was the founder and CEO of Zen Banks Holding Limited before its acquisition by SoFi. Arkadi has served on the Ivey Business School Advisory Board from 1997 to 2017 and was campaign co-chair during Ivey's campaign for leadership. He received an HBA and MBA degrees from the Ivey Business School and was awarded an honorary Doctor of Laws degree from Western University. Arkadi, thank you for joining us today. With that, it is now my honor to introduce our speaker today, Dr. Jay Ritter. Jay, I've known Jay quite a long time. He's a friend of Canada. He often vacations in Canada over the summer, before COVID, of course. And so before, we actually arranged to have him come and speak last year, but had to cancel and postpone to this year. It wasn't a challenge to ask him to come, in part because of his affection for Canada. So Jay, we welcome you here today. Since 1996, Jay has served as the Joseph Cordell Eminent Scholar at the Department of Finance, University of Florida. He is widely known as Mr. IPO for his extensive work on initial public offerings. During 2014-15, he served as president of the Financial Management Association. He received his BA, MA, and PhD from the University of Chicago. To me, Jay stands out in at least three ways. First, he's a pathbreaker. He often is the first to examine important phenomena, whether it's first-day returns in IPOs, longer-run firm performance, or strange patterns in underwriter compensation. Second, he's courageous. His explanations for phenomena are often at odds with strongly held academic views. He championed behavioral explanations when what we know now as behavioral finance was far from mainstream. His willingness to tilt at windmills has meant that his work has often been very important for practice. His research on IPO fee clustering at 7%, for example, led to a US DOJ investigation. He consulted for Google before it went public to advise on the merits of its proposed auction mechanism for selling shares. And he testified before the US Senate Banking Committee on the Jumpstart Our Business Startups, or JOBS Act, before it was enacted in 2012. Finally, and to me, maybe most importantly, he's incredibly generous. He's always quick to respond to questions, provide data, or encouragement. So as someone who does some work on capital raising also, I see Jay as a real mentor and role model. So I'm thrilled to be able to host him today to talk about his new research on special purpose acquisition companies, or SPACs. For those joining us, again, if you have questions along the way, please put those into the chat. I'll bring that back later on and when we get into Q&A. But for now, Jay, over to you. We look forward to the presentation.
Craig, thank you for the kind words. The discussion today is based upon a working paper that I have with Minmu Gang, who's a doctoral student here at the University of Florida, and Dongheng Zhang, one of our doctoral graduates, who's a professor at the University of South Carolina. SPACs, a year ago, hardly anybody had heard about them. And then last year, there was a huge boom. In most years in the last 2 decades, maybe 20 SPACs had gone public in the US and maybe one elsewhere around the world. In 2019, 59 went public in the US, and it quadrupled last year to 248. And then the first 3 months of this year, about 100 per month were going public, quadrupling last year's pace. The last 2 months, things have slowed down a lot. And a lot of people have talked about, has there been a bubble? And in terms of quantity, absolutely. In the last 12 months, more than 500 SPAC IPOs have occurred, just an unsustainable pace. Now, let me first describe how these SPAC IPOs work. A sponsor, a middleman, creates a company, a SPAC, with the intention of raising capital from initial public offering investors. And almost always a unit is sold for $10 each. And the unit is typically composed of 1 share of stock plus a warrant, which is a stock option, to buy a fraction of another share. And that fraction might be the right to buy a full share, or half a share, or a quarter of a share, or even nothing. There might not be any warrant at all. And typically the SPAC contract has the money raised in the IPO put into an escrow account, a trust account, where the public market shareholders have the right to get their money back at the time of a merger, or if 2 years has gone by without a merger occurring. So there's a deadline. The sponsor, after collecting the money and putting it into the escrow account, then has 2 years to come up with an operating company to merge with, where they've got to sign a merger agreement, and they've got to get the public shareholders to agree to the merger. And the public market shareholders get to vote on 2 things. They vote on whether to approve the merger or not, where a majority or supermajority approval is needed. And separately, they each individually decide, do I want my money back or not? If they get their money back, then they forfeit their share, but they get to keep the warrant. So this redemption option, this money back guarantee, results in no downside risk for the investor. And the warrant gives them upside potential. Plus, if they don't redeem, they get to keep the share. And so their basic decision is, if the share is above $10, you can either sell it in the market or keep it. And if it's below $10, ask for your money back. It's actually even a little bit better than that, in that the escrow account is collecting interest, so you get your money back with interest. So, this is a great deal for the IPO investors. What happens then with a merger? We can think of the timeline, the SPAC life cycle, where we've got this IPO period where a merger needs to be proposed either within 18 months or 2 years, and completed within 2 years. If not, the sponsor can ask the shareholders for an extension, but if they do so, the shareholders also have the right to redeem. So they can get their money back if no merger is about to be completed. And then once a merger is completed, the SPAC shares become shares in the new public company, and the ticker symbol changes. And that private company has now gone public by merging with the SPAC. And it trades under the name and ticker symbol of that operating company. And that share price might go up, might go down. There's no longer a money back guarantee. It's just like any other stock. If this company outperforms, the stock is going to do well. And if it underperforms, the stock is going to do poorly. So it's, once the merger occurs, there's no difference than if the company had gone public with a normal IPO. Now, these SPACs are closely patterned after Canadian capital pool companies. The main difference is that the CPCs on the Toronto Venture Exchange are typically raising just a few $1 million. Recently, the maximum was increased to $10 million. These SPAC IPOs, on the other hand, are bigger. They're usually at least $50 or $100 million, and more typically $200 million or $300 million, sometimes even a little more than that. So that the SPACs, the sponsor then has $200 million or so in cash to invest in an operating company and take it public, providing that the shareholders don't redeem. So when the SPAC IPO occurs, there's an underwriter. Investment banks take it public, and they charge fees just as with a regular IPO. It turns out almost all the time they ask for fees of 5.5%, and they take 2% up front, and then 3.5% only if a merger occurs. So the $10 offer price after the 2% fees up front gives $9.80. And what the sponsor usually does is the sponsor buys some warrants and pays a fair market price for the warrants. And typically on a $200 million deal would put in $7 million in cash, and $4 million of that would go to top up the trust amount. So instead of $9.80 being put in, $10 is put in. So essentially the sponsor is paying those upfront investment banking fees. Therefore, for the public market investors who have put in $10, they're going to get at least $10, plus they've got upside potential. So this has been a great investment for those IPO investors. Now, the sponsor also typically gives itself 20% of the shares, actually buys them for like a penny per share. But the sponsor shares don't get to vote. And they don't have any access to the money in the trust account. So with these extra shares, the SPAC might be selling 20 million shares, raising $200 million. And the sponsor takes 5 million shares. So there are going to be 25 million shares outstanding. And that results in $8 cash per share as the assets of the SPAC. Normally they try and negotiate a merger with at least $10 per share. So something has to be created of value to come up with that extra $2. As I said before, if the stock price is below $10, investors just ask for their money back. Typically 2 months after the IPO, the unit becomes unbundled where the shares and the warrants start trading separately. And if no merger occurs, things get liquidated, the sponsor loses everything. So the sponsor potentially is going to lose $7 million if no merger gets approved. On the other hand, if a merger is approved, they've got 5 million shares that might be worth $10 each. That's $50 million plus warrants. And they only put in $7 million up front. So this is a great investment for the sponsors. And it's no surprise that there have been lots of sponsors willing to create SPACs. In the last 12 months, 500 of them. So there are three main players, and there are some conflicts of interest between the players. You've got the private operating companies that are going to be merging with the SPAC. You've got the sponsors, the middlemen, and you've got investors. What's best for the operating company and investors is not necessarily best for the sponsors. If everything goes well, they'll all do well. But as that deadline approaches, the sponsor is in a situation where if there's no merger, they lose everything. So they've got an incentive to find any deal rather than just a good deal. There's a conflict of interest there. Now, this is kind of similar to private equity and venture capital investing, where you've got a middleman, the general partner, where they raise money from limited partners, where the limited partners commit to invest whenever there's a capital call. And they also set a deadline, typically 5 years in which to invest and 10 years in which to exit. And you've got the same problem there. As that deadline of 5 years approaches, the middleman has an incentive to make investments in private companies. Otherwise, they don't get the money from the limited partners. So why do we see these deadlines in the first place if they create these bad incentives to do any deal rather than just a good deal? Well, for both the limited partners or the SPAC investors, they've got some money tied up. There's an opportunity cost, and that's why they put in a deadline. Otherwise, the middleman might have an incentive to just sit on the money for year after year after year, creating an illiquidity problem. So the deadline is there to deal with an agency problem. But that solution to the one agency problem creates a new agency problem. Now the middleman has an incentive to do any deal as the deadline approaches. But with SPACs, this is where the public shareholders have some bargaining power, because they not only have to approve the deal, but they also have the right to get their money back. If they don't like the deal, they ask for their money back, and the SPAC sponsor has this problem then. They have no money to complete the deal. What typically happens is either all of the investors ask for their money back or none of them do. They're all making the same decision. Is the stock price above the trust value, in which case I don't redeem, or is the stock price below it, in which case I do redeem? And for the operating company that negotiated the merger, well, typically they're negotiating a couple of things. One is, okay, what are the merger terms? If we're getting $200 million, is that giving the SPAC investors 1/3 of the company, which implies a pre-money value of $400 million? Or are they getting 10% of the company, which implies that the pre-money value of the operating company was worth a lot more than that? And then there's also, what's the minimum amount of cash that's going to be delivered? There might be $200 million in the trust account, but they might insist on at least $100 million being delivered. If too many people redeem, the operating company has the right to call off the merger. So that gives the sponsor an incentive not to do a bad deal, because what's going to happen then is if the investors don't like it, they're going to redeem their shares that are for the cash in the trust account, and the SPAC isn't going to have money to complete the merger, and the deal is going to fall apart, and the sponsor loses everything. On the other hand, the SPAC sponsor might bring in a PIPE investor, a private investment in public equity. And that might be the sponsor itself buying 10 million shares at $10 each in order to have $100 million. Or they might approach a mutual fund and say, look, here's an opportunity for you to buy shares. Or they might go to a private equity firm and say, you know, here's an opportunity for you to buy shares at $10 each as well. And for the public market investors, they like there to be a pipe investor because, you know, when the sponsor says we're merging with this private company and we're valuing it at $400 million, you know, it's difficult to value these private companies. But if there's a pipe investor that's going to be putting in $100 million, that pipe investor has an incentive to do due diligence, to investigate closely and decide, yeah, this really is a good investment. The shares really are worth at least $10 each. I'm willing to make that investment. And so if the pipe investor is willing to buy at $10 each, that's going to give public market investors a lot of confidence that the stock is worth that much and they won't redeem. So almost all of the deals recently that have been completed have involved a pipe investor putting in additional cash. So the SPAC might have 200 million, but they might be having another 100 million pipe investment. So they've got $300 million to give the operating company. Well, this implies that the operating company has to be pretty big. There aren't that many private businesses that can absorb $300 million in cash and not waste it. So a lot of these SPACs are not competing for tiny companies to merge with. They're all looking for companies that are worth at least 500 million, maybe $1 billion, that are big enough to absorb 200, $300 million. So they're looking for, in many cases, a unicorn, a $1 billion company to invest in. And there aren't all that many of them. Right now, there are over 400 SPACs that have gone public that have a deadline to complete a deal, and they're looking for a merger partner. So the press has been reporting that a lot of the candidate companies, you know, a private company with a market cap that might be worth 500 million or $1 billion are getting calls from dozens of SPACs saying, we want to merge with you. And it's really increased the bargaining power for those operating companies. Well, as I mentioned before, we've got some of these contractual terms, deadlines that deal with one agency problem, but they create another deadline. And the separation of voting for a merger and the ability to ask for your money back deals with another potential agency problem. A lot of the IPO investors historically have been hedge funds, and they might buy a big chunk of the stock, 5 or 10%, and they might have a big enough share to affect the outcome of the merger vote. And historically, there's been a bit of a problem. What if the contract required 60% approval and 58% of shareholders were voting in favor and a hedge fund held another 6%? They can swing the merger. And what they would sometimes do is call up the sponsor and say, look, if we vote against it, it's history. You lose everything. In return for us voting in favor, give us something. You own 5 million shares, give us 1 million shares. Then we'll vote in favor. And you'll only have 4 million shares left, but you know, they won't be worth nothing. And some hedge funds did this. They became known as the SPAC mafia. And as a result, the SPAC contracts changed to separate the voting. So now the hedge funds can't say, you know, give us shares or we'll refuse to vote in favor, because they know that if they don't vote in favor, their warrants are going to become worthless. and they can get their $10 back whether or not the merger occurs. Well, companies, private companies, have multiple ways that they could raise money and go public. Traditionally, in both Canada and the US, most have done a traditional IPO. And we can look at the costs of doing that. It's expensive. We can also look at the costs of a SPAC merger, where the SPAC is paying underwriting fees in the IPO. And then the sponsor is taking the shares. So there's a dilution cost. And when we add up the value of these things, it turns out that either as a fraction of market cap or as a fraction of the amount of cash delivered after redemptions, on average, a SPAC is an even more expensive way of going public than a traditional IPO. There have been some direct listings where a company goes public without issuing shares, where the stock just starts trading. In fact, today, ZipRecruiter is doing a direct listing and going public without the company issuing any shares. And these direct listings are a lot cheaper. To date, they've only been used by a small number of companies, mainly big tech companies, many of which have already been cash flow positive. Spotify was the first one that did it in the US in 2018. So if SPACs are so expensive, why are companies, operating companies, merging with a SPAC rather than doing a traditional IPO? Well, presumably there have to be some advantages that offset these costs. Well, there are a couple of reasons that have been given for why merging with a SPAC might be more attractive for an operating company. It might be quicker. Going public takes a long time. Between you start the process and actually complete the deal, might take at least 6 months. And who knows what market conditions are going to be 6 months from now. It's a really high stress period for an operating period. They don't know how much money they're going to raise. They don't know the terms of the deal. They don't even know whether the deal is going to get completed. Whereas negotiating a merger with a SPAC, you can negotiate the terms now. There's a pretty high probability that the deal will get completed. And so that might be a reason for a SPAC merger rather than a traditional IPO. It's also the case that not all sponsors are the same. Some sponsors are very knowledgeable about an industry and might be adding some value by bringing some people into the company that can offer useful advice and make the company worth more. It's also the case that with PIPE investors, et cetera, it's possible more capital might be able to be delivered. Now, these are some of the reasons that have been given. Whether or not these are valid reasons or just perceptions is another question. And things can change. Like until the last month or two, most of the time SPAC mergers were faster than IPOs. But the last couple of months, things have really slowed down. The majority of deals that were announced in December, mergers that were announced in December, still have not closed. So it's taking as much time as a regular IPO, and that might make merging with a SPAC less attractive than it had been. There's also an important issue that's sometimes called regulatory arbitrage. In the United States, when a company does a securities offering, they generally don't make forward-looking statements like making earnings projections or revenue projections. this varies across countries. Canada doesn't have the same legal environment as in the US. US companies aren't prevented from doing it. They just don't do it because they're so afraid that if they don't meet the projections, plaintiff lawyers are going to pounce and sue the company and the officers and directors. So in practice, they don't make forward-looking projections. Now, in practice, what happens in the roadshow is somebody in the audience might ask, what are your earnings forecasts? And the chief executive officer will typically respond to the institutional investors asking the question, well, we don't give earnings forecasts, but the analyst at our lead underwriter who's going to be covering the company is making the following forecast. And everybody understands that the analyst got the numbers from the company. So there's kind of a wink and a nod that the company really does make some forecasts. But with a SPAC merger, it's regulated as a merger. And in the US, with mergers, typically forward-looking statements are made. Two companies that are merging with each other, like two banks, might say, well, look, the reason we're merging is we project $50 million a year in annual cost savings and $40 million a year in revenue enhancements. And that's why this deal makes sense. And there's a safe harbor where plaintiff lawyers would have to prove that the company knowingly made misleading statements. If things don't work out, the company is given the presumption that it was just due to bad luck rather than intentionally misleading investors. Now, this has been an argument for why SPAC mergers might be more attractive than a traditional IPO due to this regulatory arbitrage. But just within the last couple of weeks, the acting director of the Division of Corporate Finance at the Securities and Exchange Commission has said, hold it, let's not be so sure about this. The SEC does not define what an initial public offering is. And these SPAC mergers look an awful lot like an IPO. The company is going public, it's raising capital. Looks like an IPO to me. So don't be so sure that there's this regulatory arbitrage, that the legal rules are different. So this might be one of the reasons why there's been a big slowdown in the SPAC market recently. It's also the case that the SEC had said, let's think about the accounting for these mergers. The sponsors have shares and warrants. Should these warrants be counted as an expense on the income statement? After all, warrants are just like employee stock options. In fact, employee stock options are warrants. If they're exercised, the company will be issuing new shares. And employee stock options have to be expensed when they're granted. Why shouldn't these sponsor warrants be expensed? All of a sudden, the accounting numbers are being changed. And I've been told that a lot of deals that were in process, where a deal had been announced, a PIPE investor or investors had been lined up, a lot of the PIPE investors are saying, hold on, we want to renegotiate. We've seen the price drop, and the fine print said if there's a material accounting change, we can renegotiate. And expensing warrants, we're going to claim is a material accounting change. So a lot of the deals that have been announced but not completed, 146 of them, are taking a long time to get done. Partly, a lot of them, the stock price is below $10, and a lot of shareholders are going to be redeeming. PIPE investors are demanding renegotiation. I expect some of these deals are not going to get completed. Well, what about these redemptions? Well, it turns out, some deals, the stock price is below $10 and almost all investors redeem. And there are other deals where the stock price is above $10 and almost nobody redeems. Well, what happens to the sponsor? Well, if the stock price is above $10, the sponsor typically keeps all of their shares. But if the stock price falls, a lot of times the sponsor is in a situation where it says, look, in order to keep the deal from collapsing, I'm willing to give up part of my cut. I'm willing to give some shares to a pipe investor or maybe even to a hedge fund to make sure there's enough cash to complete the deal. And furthermore, the operating company might negotiate where the SPAC sponsor owns 5 million shares, but they might say, look, we are only going to allow you to keep the shares, all 5 million, if the stock price is at least $12 a year from now. In other words, there might be some vesting provisions that the 5 million shares aren't automatically kept by the sponsor, that they get to keep all 5 million shares only if certain targets get met. And in negotiating the deal, the SPAC sponsor might also be putting in conditional compensation with the operating company. They might say, okay, you're going to get 25 million shares, you get half of the company. But if revenue doesn't meet certain targets, you have to give back some of those shares. So one advantage of merging with a SPAC is you can make these contingent payments. Whereas if you do a traditional IPO, you don't have these contingencies. You don't have the ability to negotiate extra compensation or a reduction in compensation if certain targets aren't met in the future. It's also the case that sometimes the underwriter takes a haircut. If the deal is in trouble and lots of shares are redeemed, the underwriter might say, well, look, you still owe us 3.5% on all 20 million shares that were sold, but 18 million shares have been redeemed. We're not going to demand getting paid for the shares that got redeemed. If the stock price is high, they get all of their money. But if the deal is in trouble, the underwriter might be willing to take a haircut to keep the deal from collapsing. So how have investors done? Well, in the SPAC period, from the time of the IPO until a merger gets completed or there's a liquidation, for IPOs from 2010 until last October, the returns, actually the IPOs through May of 2018 and then returns through last October, the average annualized return was 9.3%. Not huge, but on the other hand, not a single deal had investors lose money. Even on deals where they were liquidated, investors still got their $10 plus interest. So this is a great investment for IPO investors. No downside risk, and you've got upside potential. 9.3% per year is a pretty attractive return for such a low risk investment. It's no wonder that hedge funds have been happy to buy these. And more recently, when the number of IPOs exploded, a lot of mutual funds and retail investors like me started buying the SPACs. What about after the merger? Well, there the returns haven't been as good. The average return has been minus 15% in the year after the merger. That's equally weighting. The number is down at the bottom there, minus 15.6% per year. Actually kind of in the middle there. But that's a little misleading because some of the deals that did the worst were predictable. These were the deals where almost everybody redeemed and the operating company said, well, look, we negotiated that you deliver $100 million. You've only got $6 million, but we'll take it anyway. Well, you know, a company that's so desperate to go public, investors look at it and say, you know, this isn't very good. And it turns out almost all the time, it isn't very good. Lots of those deals have declined by 90%. So if we weight by the amount of cash that investors actually invested that they didn't redeem, the average return is not minus 15%, but it's minus 4%. And this is during a period when the stock market was going up. So this is underperforming the market by a lot. But this is the shares only. Investors in the IPO also got to keep their warrants. And in the year after the merger, the average warrant has actually gone up 44%. So when you take the warrants plus the stock, the return numbers are better. Now the warrants aren't worth as much in terms of the money involved as the shares. So we can't just take half and half. If we weight by the amount, the market value of the warrants and the market value of the shares, the total package has been okay. But you know, the stock investors have not been doing well on average. And this is not sustainable. You know, investors aren't going to be willing to keep buying the stock at the time of the merger when many of the hedge funds sell, if on average they're losing money. And also the PIPE investors have been underperforming a bit. This is why they've been so anxious recently to renegotiate when they can, because they've been underperforming the market as well. Well, these are the historical numbers. Great returns during the IPO period, pretty poor returns during the post-merger period, which is also known as the de-SPAC period. What about on a point-forward basis? Well, last week I made a presentation to a major investment banking firm where they were interested in what about on a point-forward basis. And I said, look, there are so many SPACs out there looking for merger partners. I don't think a lot of them are going to be able to complete a deal. So let's assume that 1/3 of them wind up liquidating. So for the $10 that was invested, investors are going to get $10 plus interest back after 2 years. And with interest rates being so low, maybe they earned a 1% return total, which is only 0.5% per year. What about 1/3 of the other deals? Well, I expect that they're going to have high redemption rates, but the warrants will still be worth something because the deal got completed. What if the warrants are worth 50 cents each? Well, then you got, say, 1% on the shares and 5% on the warrants, a total of 6% on your $10 investment. But if that took 1.5 years on average to get your money, that would be a 4% annualized return. And then maybe 1/3 of deals will complete mergers where it's going to be attractive enough that the stock will be worth more than $10, say $10.50, and the warrants might be worth, say, 75 cents. Well, then if we add these together, the total return would be about 12.5% over 1.5 years, about 8.2% annualized. So if we take a 1/3, 1/3, 1/3 of these three different scenarios, the average return during that SPAC period, the IPO period, is going to be about 4.2% a year. Nowhere near as good as it used to be, but still okay, given that there's no downside risk unless there's fraud or something. So, on a point forward basis, these aren't going to be as good. Why not? Well, one, as I mentioned, too big a supply. But the other thing is that the warrant terms aren't as generous as they used to be. If we look at the last 3 years and the evolution of the SPAC market, the blue line here is how many warrants you get for each unit. If we count one whole share as 100% and half a share as 50% and a quarter of a share as 25%, well, in the first quarter of 18, so 3 years ago, the average SPAC unit was offering about 0.8 shares per warrant. But as it became easier and easier to find buyers, the sponsors didn't have to be as generous. So they started saying, well, okay, we'll only offer half a warrant. And the first quarter of this year, it was only 0.4 warrants. Since then, it's actually been even a little less than that. So if a warrant to buy a full share is worth $1 and a warrant to buy a quarter of a share is worth only 25 cents, the package isn't as attractive as that warrant fraction has come down. So that's the oversupply, and the fact that the warrant terms aren't as generous is why I don't think the returns over the next year or two are going to be as attractive as they were over the last decade. Okay, so one other comment, the red line here. Until January and March of this year, typically a SPAC went public at 10 and started trading at about $10 or maybe $10.05, up 0.5%. So not like a traditional IPO that might jump 30% on the first day of trading. So whether you bought at the offer price or bought in the market didn't matter too much. But in January and February of this year, investors figured out these are great deals. And the stock prices started jumping by 5 or 6% on the first day of trading. So getting the shares at the offer price of $10 was worth a lot more than having to buy in the market at $10.50. But since February, the prices have come back down. Now, when trading starts, it's typically at $10. Yesterday, a SPAC went public and closed at $10. Today, 3 or 4 SPACs are going public, and they'll probably end the day at right around $10. Indeed, for the hundreds of SPACs that are out there searching for a merger partner right now, the majority of them, the current share price is below $10. Not a lot below, but $9.80, $9.90, even though you're going to be able to get $10 plus interest if you redeem, and maybe even more than that if you don't redeem. But investors are demanding a little bit of a discount to compensate for the illiquidity that's involved. So the days of easy money are gone. Right now you can buy a SPAC unit at $10, or once they become unbundled, you can buy a share for like $9.80, and the warrant for maybe 40 cents or 50 cents or 60 cents, depending upon how big a fraction of a share that you get. One last comment on that is the SPACs today that are offering a half share are different than the SPACs that are offering a quarter of a share. They offer a fraction based upon what investors are requiring. The high quality sponsors don't have to offer as much. So the more that's offered, the lower is the quality of the sponsor, on average. Okay, so let me conclude, and then we've got the opportunity for some questions. A SPAC is a more expensive way of going public than a traditional IPO, but lots of companies are doing it. Why? Well, there's got to be some offsetting advantage. And some of those advantages might be a perception that it was faster or more certainty about getting money. And that has been the case, but the deal terms are changing and market conditions are changing. And it's not so clear that the speed advantage is there anymore. Historically, the returns for the IPO investors on a risk-adjusted basis have been very attractive. The returns after the merger have not been attractive at all. This is not sustainable. And it's been changing. I expect that in the future, the post-merger returns will be better. Otherwise, why will people keep buying these at the time of the merger? So the SPAC market continues to evolve. I don't think there are going to be anywhere near as many new SPAC IPOs as we saw at the beginning of this year when 100 per month were going public. Last month, only 18 went public. This month, it looks like about 22 will go public by the end of this week. But I expect that will be coming down even more. There are over 200 SPACs that have filed to go public, but I think a lot of the sponsors are not going to complete the IPO. A lot of them are going to say, hold it, we thought this was going to be a great deal, but now that there's so much competition out there, is it worth risking losing $7 million? Some of them will say yes, but I think a lot of them will say no. And I think a lot of the deals that have been filed to go public are going to wind up being withdrawn. There'll probably be at least a few IPOs of SPACs each month. There are over 400 looking to announce a merger. There are 146 that have announced a merger. And I think some of those, the merger is going to fail. That too many people will redeem and the operating company will say, no, you don't have the cash to complete the merger. We're pulling out. So, things are evolving. It's something you should pay attention to. There's no mechanical rule of always buying at the IPO or never buying at the time of a merger. If you're going to play this market, you've got to pay attention. But I don't think that there's going to be a worldwide boom in SPACs. I think what went on in the US in the last year was a once in a lifetime situation where I don't think they've got huge advantages for most companies over a traditional IPO. Okay, so let me turn it over to Craig and we can have some questions.
All right, Jay, that was fantastic. As expected, I really appreciate it. There are a bunch of questions already coming in, some sort of the clarifying nature. So maybe I'll start with them. And
Okay.
of course, I reserve the right. It's my right here to also ask a few questions that pop to mind. So just to clarify a couple of things coming in, for a regular investor, you noted that when the SPACs are first listed, they're a bundle, it's a unit of a share and a warrant, but at some point they detach and they trade separately. Is it, when you're looking at these, is it obvious when that has occurred in terms of, we know lots of examples of mistaken ticker symbols right? Where companies are buying the wrong company. Lots of great anecdotes around that. Is it obvious? What's the sign in terms of when this is detached?
For the unit, the shares, and the warrants, there are three separate ticker symbols. Typically, the warrant ends with a W, the unit ends with a U, and the share ends with neither. So it's pretty transparent, and it's up, if you bought the unit like I did,
Yep.
It's up to me to then sell it either as a unit or sell it as two parts, or I could sell one part and keep the other. I could redeem the share and keep the warrant or sell the warrant. It's up to me. Frequently, there's limited trading volume in the unit before a deal is announced. And then when a merger is announced, typically there's a surge in trading volume. And then, after the merger occurs, it trades like a normal stock.
Right. So another question just relates a little bit. You talked about what happens to the share price, right? And what are the returns to investors over this period? Just curious in terms of the pre-SPAC, before the merger occurs. As you look at the share price for these units, or once they detach shares, I'm assuming, but correct me if I'm wrong, that for the most part, until a deal is announced, the share price will just sort of float around $10. There's no reason for it, unless there's rumors of a merger coming. So when are the shares generally around $10 when the company announces that they found something? Or do you see strange patterns?
Yes, that's the current practice. But what happened last fall and in January and February, a lot of the times investors had bid up the price to 11 or 12, or in some cases they just felt a lot of enthusiasm for the sponsor, and the price went up to kind of a speculative premium. Right. And then when a deal was announced last year in January and February, typically the price would jump. Actually, in the last month or two, frequently the price hasn't moved much, and sometimes it's even fallen a little bit. So, investor sentiment has definitely changed. But this is on average. There's still some mergers where investors are really enthusiastic about the operating company and the deal terms. Just like with a regular merger or a regular IPO, there's both issues of how good is the company and what are the terms. Right. It might be a great company, but if the price is too high, it's not a great investment.
I've always thought that about Apple, and I've been wrong. So what can you do?
Okay. By the way, I'm short in Tesla. I'm short in GameStop. So, okay. Fortunately, I'm long in some other things that have done well.
Excellent. I celebrate my mistakes. I learn from them. Okay, another question just relates to looking at the companies that do, I guess, go public ultimately by being acquired. Do you see interesting industry variations? Do they tend to be certain types of industries? Do you ever see VC-backed companies, for example, being companies that are acquired here? And I actually have a question from our sponsor for this, Arkadi Kuhlmann, around, are these mostly companies, with no revenues, but a good idea, that are trying to jump into the public markets?
Yeah, it's varied over time. In the last year, a lot of so-called clean tech companies, electric vehicle companies, battery, stuff like that. A couple have gone public in IPOs, but a number have done mergers with SPACs, like Nikola, Lucid, Fisker, and that the prices had gotten bid up. Now they've come down quite a bit. A number of these have had zero revenue. And so in that regard, the critics of SPACs are saying, well, look, some of these companies, which were venture capital backed, have gone public too early. that if they were relying on traditional IPOs, investors would have said, go through another round or two of venture capital, and if you're successful, then you can go public.
Right.
Some of these electric vehicle companies have been announcing recently, well, in the merger announcement, we were making these projections. By the way, we haven't been able to meet those.
Oh.
And so there's been some disappointments. But a lot of traditional industries have been represented as well, some mature companies. But what's noticeably been lacking among SPAC mergers is biopharmaceutical startups.
Okay.
In the last 9 years, lots of them have gone public versus traditional IPOs, but so far, very few of them have been doing SPAC mergers.
Okay, interesting. What about foreign companies? Do you see mergers occurring, or is this all domestic?
No, there are definitely some US SPACs buying foreign companies, Chinese companies. The deal that's gotten the most attention is the SPAC merger with Singapore's Grab ride-hailing company, which put a pre-money value on the company of close to $40 billion. And it was a big SPAC, $500 million cash, but they also brought in $4 billion of pipe money. So Grab is going to be getting $4.5 billion in cash and have a valuation post money of over $40 billion.
Wow.
Grab is a great company and, is big enough and with a high enough burn rate to potentially usefully use that much cash. There aren't too many companies in that situation. This has been by far the biggest SPAC merger ever. It hasn't been completed yet, but this is a deal that's widely expected to get completed.
Well, it does, and you noted in your presentation, they don't have to be that large, but they do have to be large, right? You mentioned that you talked about unicorns, right? And I always thought that the unicorn meant you don't see them very often by definition, right? They're meant to be things that are hard to spot because you don't actually see these things in reality. So with, again, not to ask you to give investment advice, but if I'm thinking about all of those SPACs that have come out in the recent, few months or the last 18 months, let's say, there is a real challenge there in terms of actually finding deals that have the potential to work, isn't there? I mean,
I'm in complete agreement with you that there are a lot of great companies out there that I think will be merging with SPACs, but the bargaining power is definitely in the operating company's hands now. If you've got a private tech company, and it doesn't have to be tech, with a pre-money value of $1 billion, where you can absorb $200 million without wasting it. There are literally dozens of SPACs that have probably contacted you already.
Right.
And a term that's come up is a SPAC off, that the company can play them against each other and decide who's offering the most attractive terms. If there are 10 SPACs willing to give us $200 million, and one of them is insisting on they get 13% of the company, and another is insisting that they only get 9% of the company, well, 9% leaving 91% for us is a lot better than leaving only 87% for us.
Okay, interesting. Okay, so a bunch of other similar questions popping up. Maybe I'll start with one of my own. In your paper and a little bit in the presentation, you talk about the fees for underwriters, and you talked about the 5% overall, 2% upfront, 3% at the end, and sometimes the underwriters will accept a bit of a haircut. But you've been famous for your work on 7% solution, that there's this clustering of fees in general for IPOs that some, not other researchers said maybe that's high. I don't know, right? Certainly you don't see those kind of fees elsewhere in the world. There's 2%. Let's ignore the emerging part. For a, as you described it, a risk-free, right? Sort of like a convertible bond, but it's like a risk that's really safe. It's almost like a bond, a convertible bond type investment, but very safe. Does that strike you as high? Curious on your view on the fees and whether.
Yes. 10 years ago, the bulge bracket underwriters, the most prestigious underwriters, weren't doing these SPAC deals.
Right.
And before 10 years ago, a lot of them then traded over the counter. In the last decade, they've all traded on NASDAQ or the NYSE. You've got the top underwriters doing these deals. So they view it as attractive. The quality of the sponsors in many cases has improved. You've got, in general, higher quality people across the board being involved. With the escrow accounts, there are checks and balances where it's not like blind pool offerings from 40 years ago, where it was a lot of fly-by-night stuff, where somebody would raise $3 million and then pay it to themselves. And investors would lose everything or buy the brother-in-law's company at an inflated price and split the money with the brother-in-law, and investors would lose. Not every deal is the same, but you've got hedge funds that are paying attention, bought $5 or $10 million worth of stock. They've got an incentive to pay attention. You've got pipe investors putting in $100 million, where it might be T. Rowe Price or Ontario Teachers Pension Fund, right. Putting the money in. They're doing their due diligence. So the quality has definitely improved, but the 5.5% underwriter fees have been pretty sticky, and that 20% sponsor shares have been very sticky. But what you see is the fine print changing. As I mentioned before, with the sponsors, more and more there are vesting provisions or longer lockup provisions. And so the incentives are getting better aligned, that they get their 20% only if things go well.
Okay. So you talked a little bit about the big firm, Goldman Sachs, JP Morgan, Morgan Stanley, not really participating, but starting to in the more recent period. And although different, right? We both very familiar with other types of IPOs, unit IPOs, right? They're for companies that are already operating are very common. We often call the units, the warrants, they are sweeteners that have been added. I remember research going way back talking about how that's a form, it could be thought of as a form of stage financing. Starting with, I think it was Schultz was one of the first researchers to look at this. But almost very similar in that they were always kind of very early stage, speculative, risky, and not often led by the really top premier institutions. So does it feel different that is it surprising to you at all that Goldman Sachs would get involved here, whereas their long history of unit IPOs, I'm not sure they played such an active role?
Well, the units with the warrants, the warrants that the public market investors have typically have a 5-year maturity starting at the time of the merger, not starting at the time of the IPO. Right. And almost always they've got an exercise price of $11.50, so a 15% premium over the $10 offer price. And they're usually capped at $18. So they've got upside potential, but only limited upside potential. But you mentioned stage financing. Yeah. If the stock price goes up, then investors are going to exercise those warrants and give the company more cash. And that has the feature that the company gets the extra cash if and only if the stock price goes up. If the company isn't performing according to plans, the company isn't going to be getting extra cash in the future when presumably it hasn't been able to convince investors that it would use it wisely. So, the logic for this is there, but the warrants are definitely a sweetener. What we've seen recently is some of the higher quality sponsors are able to find investors for the IPO even without offering any warrants. Just the upside potential from the shares is enough. Essentially, it's similar to a convertible bond, but it's even better than a convertible bond. It's a default-free convertible bond, and the warrants give even more upside potential.
So I really appreciated your sort of go forward, right? Because so much is changing, so much is evolving in terms of what might happen. Certainly looking at the history, an IPO investor in that first, seems like a no-brainer. I'd definitely jump in there and I'd try to invest there. But on your go forward basis, a couple of things jumped out to me. I'm not sure what your thoughts are. One is that given the structure and how the structure is changing, maybe 9% will not be replicable going forward. The other piece that jumped out to me is that first day returns are starting to creep in 5-6%. So I'm doing some mental math. Stay with me here. If I'm a retail investor, this sort of harkens back to IPO investing. If I don't happen to be lucky enough to get allocated shares in the IPO, should I not jump in? So if I may be looking at 4 or 5% on a go forward basis, and all of that is eaten away on first day returns, as a retail investor, would you say, maybe not jump in on day 2 or 3 compared to the past?
I agree with you that if you can get at the $10 offer price, there were good investments. If you've got to pay a premium by buying in the market, there's not a free lunch sitting there. Indeed, I started buying IPOs of SPACs last fall. Then in January, when they started jumping to a premium, I started holding off because just like your calculations, if I've got to pay a premium, a lot of the upside potential has already gone away. Now, in November, December, January, and February, when investor enthusiasm for SPACs was really high, prices kept going up. And I was patting myself on the back about what a great investor I was, having bought these SPAC IPOs, where in just a matter of a couple of months, I had made 10%. However, I've lost it all since then. When that investor enthusiasm faded, but I've still got the downside protection.
That's somebody else's fault. All the good stuff was your decision making, though. Okay, a couple of other quick things, a couple of questions. So one other question is, you mentioned how the bargaining power in the mergers here, right, for these mergers are maybe tilting towards the acquiring, the firm that's being acquired. What about in general, right? The fact that there are so many of these SPACs out here that have just been created now looking for deals. If I'm thinking about what might be happening in the general M&A market, is this big enough to potentially impact the bargaining, the deals? Could we see a wave in general in the M&A world? Is there a chance that could flow over?
Well, buyout firms, venture capitalists, others have been thinking about this as well in terms of for companies with roughly $1 billion valuation. You've got all these potential SPAC investors where some of the venture capitalists who have backed these private companies are saying, well, now might be a good time to sell. On the other hand, right now there's something like $150 billion of dry powder from SPACs. Less than that if there's a lot of redemptions, more than that with PIPE investments. But on the other hand, venture capitalists and buyout firms have something over $1 trillion of dry powder in terms of money that's been raised, capital committed from limited partners that hasn't been invested yet. So the buyout firms are saying, well, yeah, in a certain segment of the market, that there might be too much competition, but for the bigger deals, once you get above a couple of $1 billion, the SPACs probably aren't much competition.
Okay. Now you talked a couple of times about the quality of the SPAC sponsor, right? So just a couple of questions popped up and occurred to me as well. Are there repeat players in this marketplace since it's been around for a while? How does a SPAC sponsor stand out if they do have some special skill here? What do you see? Is there anything that you've spotted on that side?
Well, SPAC sponsors are like general partners for VC and buyout firms. If you've got a good track record, it makes it a lot easier to raise a new fund than if your previous deals haven't worked out. Works the same way in the SPAC market. Actually, probably the best known SPAC sponsor is a Canadian, Chamath Palihapitiya, who's been associated with a couple of very successful deals and has raised some additional funds or additional SPACs that are looking for merger partners. So, track record is definitely something that investors pay attention to.
Okay, excellent. And another question, obviously, this is sort of an ongoing debate in terms of its impact. Qualitative easing, low interest rates, right? Has that fueled at all? I mean, qualitative easing has been around for quite a while, but has that played any role in your mind in this wave or this increase?
Yeah, that's actually something that's frequently raised as a reason for the boom in SPACs. And I would say no and yes. Yes, in terms of low interest rates around the world have pushed up the prices of all assets, whether it's real estate, US equities, Canadian equities, bonds, high yield bonds, you name the asset class, prices are up because interest rates are so low. And SPACs are no different in that regard. But in terms of, in effect on SPACs in particular, where the returns from the escrow account are actually lower because they're investing in T-bills that are now yielding essentially nothing. Right. So I just don't see how low interest rates have been responsible for a SPAC boom. I think the main reason that there was such a big boom is last year there were a couple of mergers, like with DraftKings and for a while with Nikola, the electric vehicle truck startup that did very well for a while. And indeed, DraftKings has continued to do well. And money chases past returns. When investors have been making money, money flows in. And I think that's exactly what happened with SPACs.
Interesting. Another question, and I have to apologize for asking this. It's a great question, but anytime anyone ever asks me a question about taxes, I always complain about my head about to explode, right? Especially if it's anytime near April. Is there any tax effects here from a SPAC investor perspective? Is there anything different here that affects the investor view on SPAC investing?
Yeah, simple answer is no. I mentioned that starting last fall, I started buying these SPAC IPOs. Yes. When they went up at the end of February, the reason I didn't cash out was because it would have to be a short-term capital gain. Whereas if I held it for a year, then my tax rate would be lower. As it turns out, it was the difference between a higher tax rate on 10% versus a lower tax rate on 0. So, in retrospect, I should have taken the short-term gain, but I don't think there's much of a tax issue here.
That's a common question in general. So another couple of really great questions coming online. About the back to the SPAC sponsor, and I think you mentioned, or may I have read it, when the SPAC goes public, they can't or shouldn't necessarily have a target, as it were, in mind. But do you ever see examples where it sort of looks like they might have, right? It happened either very quickly, or is there any sense that sometimes maybe some of these deals are done ahead of the SPAC IPO, or is that difficult for you to be able to?
In general, I'm not aware of situations where there had been explicit merger negotiations ex ante. That doesn't mean that there has never been an informal discussion. Probably the deal that got the most speculation on that was last year when Bill Ackman's Pershing Square Tontine did a huge SPAC, the biggest ever, raising like $4 billion. And it was obvious that, they would be looking for merging with a Decacorn, a company that had a pre-money value of $20 billion or more. A company like Uber Technologies or something. And so, there was a lot of speculation that that would be a very possible merger. As it turned out, Uber Technologies did a traditional IPO and left a lot of money on the table. And Pershing Square has still not done a deal or announced a deal. But that's actually one of the few that trades at a premium based upon being somewhat unique, where the market is still expecting that there's a good chance that they'll do an attractive merger.
Interesting. One comment was that they thought the example you talked about may have been Airbnb, not Uber. Is that?
I think you're right on that.
Okay, excellent. See, this live feedback. This is outstanding. Okay, one additional question is around a lot of great skeptics or people thinking about things that might go awry. Are there examples where maybe you've got a single sponsor having multiple SPACs, maybe because they haven't completed the first, by the time they get the second? Are there potential conflicts that could arise if a sponsor has multiple SPACs in terms of where they do the deal? Is that an issue potentially?
That can be an issue. There actually have been some situations where a sponsor has done 2 IPOs on the same day. And typically it's a situation where they specify the SPAC is targeting a merger in this industry, and this other SPAC is targeting a merger in a different industry, or maybe an Asian tech company versus a US consumer goods company. Some of them just say general, and others are more specific, that we're targeting, we're likely to merge with an Asian company or a European company, or specific industry, or both, an Asian tech company.
Interesting. And I'd be remiss if, obviously, it's been such a big issue the last year, COVID and its impacts. Again, we're doing this in this format rather than face-to-face in Toronto. I'm curious of your thoughts of whether or not there's any connection. Obviously the standard, quote unquote, standard IPO market has changed, and I think maybe more resilient than we thought, right? Whether or not people thought going in that virtual roadshows would be as effective as the in-person versions. Whether or not some of this increased volume was because the perceived, challenges of doing a normal IPO, at least temporarily, went up. Do you think that's at all at play here, or no?
Yeah, I don't think that's been too important. As you pointed out, there has been a change in the last year where road shows, instead of people going from city to city, uh, talking to institutional investors, are doing it all by video now. And that's speeded up the process. 5 years ago, a typical road show might have been 2 weeks. Uh, 3 years ago, might have been 8 business days.
Right.
Now it's very frequently less than a week.
Hmm.
So the traditional IPO roadshows have gotten much shorter. And in one respect, that's been advantageous from the company's point of view of exposing them to less market risk because it's a shorter process.
Absolutely. Well, Jay, I just said I wish I could keep going. There are a lot of questions online. Maybe I'll try to consolidate and share with you if I could, just if you don't mind. But we are approaching the 1 o'clock time. So I'd like to maybe conclude at this point by thanking you again. I thanked you in advance, and I'll thank you again for a really interesting presentation, really engaging Q&A. As always, you've identified a really interesting phenomena. You've done, as you always have, a really thorough job of understanding its details, not 70,000 feet. You really dug in and understand the details extremely well and conveyed that extremely well. And given us a lot to think about in terms of SPAC investors, SPAC sponsors, how that can carry over into other walks of life. So thank you very much. I know we had hoped to do this in person a year ago in Toronto. I think in some ways we ended up with about 200 live participants, and we know a bunch of others also registered. So we'll get to reach a large audience of many, many familiar faces to names to me on the participant list. So greatly appreciate you contributing here, Jay. And as always, I very much appreciate time spent with you. So thanks so much.
You're very welcome, and I look forward to the border restrictions being relaxed so I can resume vacationing in Canada.
I look forward to that as well. Thanks so much, Jay. Thanks to everyone for joining. Again, someone did ask this has been recorded. It will be posted. So if you didn't get to see all of it or you just joined late, there will be an opportunity to see it afterwards. So again, thanks so much, and we will conclude the seminar, the Arkadi Kuhlmann lecture. So again, thanks to all for your participation.